The European exchange rate mechanism was a system introduced by the European Economic Community on March 13, 1979, as part of the European monetary system, to reduce exchange rate variability and achieve monetary stability in Europe, in preparation for economic and monetary union and the introduction of a single currency, the euro, which took place on January 1, 1999. After the adoption of the euro, policy changed to linking currencies of EU countries outside the Eurozone to the euro. The goal was to improve stability of those currencies, as well as to gain an evaluation mechanism for potential Eurozone members. This mechanism is known as ERM2 and has superseded ERM. Currently there is just one currency in the ERM2, the Danish krone. Intent and operation of the ERM is based on the concept of fixed currency exchange rate margins, but with exchange rates variable within those margins. This is also known as a semi-pegged system. Before the introduction of the euro, exchange rates were based on the European currency unit, the European unit of account, whose value was determined as a weighted average of the participating currencies. A grid of bilateral rates was calculated on the basis of these central rates expressed in ECUs, and currency fluctuations had to be contained within a margin of 2.25% on either side of the bilateral rates. Determined intervention and loan arrangements protected the participating currencies from greater exchange rate fluctuations. Historical exchange rate regimes for EU members. The chart below provides a full summary of all applying exchange rate regimes for EU members, since the European monetary system with its exchange rate mechanism and the related new common currency ECU was born on March 13, 1979. The euro replaced the ECU-11 at the exchange rate markets, on January 1, 1999. During 1979 to 1999, the D-Mark functioned as a de facto anchor for the ECU, meaning there was only a minor difference between pegging your currency against ECU and pegging it against the D-Mark. Sources: EC Convergence Reports 1996 to 2014, Italian lira, Spanish peseta, Portuguese escudo, Finnish marka, Greek drachma, UK pound. The Eurozone was born with its first 11 member states on January 1, 1999. The first enlargement of the Eurozone, to Greece, took place on January 1, 2001, 1 year before the euro had physically entered into circulation. The next enlargements were to states which joined the EU in 2004, and then joined the Eurozone on January 1 in the mentioned year: Slovenia, Cyprus, Malta, Slovakia, Estonia, Latvia, and Lithuania. All new EU members having joined the bloc after the signing of the Maastricht Treaty in 1992, are obliged to adopt the euro under the terms of their accession treaties. However, the last of the 5 economic convergence criteria which needs first to be complied with in order to qualify for euro adoption, is the exchange rate stability criterion, which requires having been an ERM member for a minimum of 2 years without the presence of severe tensions for the currency exchange rate. Irish pound breaks parity with pound sterling equals, to participate in the ERM, Ireland had to break the Irish pound's parity with the pound sterling in 1979, because the pound sterling, which was not an ERM currency, appreciated against all ERM currencies shortly after the launch of the ERM. The continued parity between the Irish pound and the pound sterling would have taken the Irish pound outside its agreed band. To fulfill the ERM conditions, the Irish government was required to break the parity of the Irish pound with the pound sterling. Pound sterling's forced withdrawal from the ERM equals. The United Kingdom entered the ERM in October 1990, but was forced to exit the programme within 2 years after the pound sterling came under major pressure from currency speculators, including George Soros. The ensuing crash of September 16, 1992 was subsequently dubbed Black Wednesday. There has been some revision of attitude towards this event given the UK's strong economic performance after 1992, with some commentators dubbing it White Wednesday. Some commentators, following Norman Tebbit, took to referring to ERM as an eternal recession mechanism, after the UK fell into recession in 1990. the UK spent over £6 billion trying to keep the currency within the narrow limits, with reports at the time widely noting that Soros's individual profit of £1 billion equated to over £12 for each man, woman and child in Britain, and dubbing Soros as the man who broke the Bank of England. Britain's membership of the ERM was also blamed for the prolonging of the recession at the time, and Britain's exit from the ERM was seen as an economic failure which contributed significantly to the defeat of the Conservative government of John Major at the general election in May 1997, despite the strong economic recovery and significant fall in unemployment which that government had overseen after Black Wednesday. Increase of margins equals, in August 1993, the margin was expanded to 15% to accommodate speculation against the French franc and other currencies. Replacement with the euro and ERM2 equals, on December 31, 1998, the European currency unit exchange rates of the Eurozone countries were frozen and the value of the euro, which then superseded the ECU at par, was thus established. In 1999, ERM2 replaced the original ERM. The Greek and Danish currencies were part of the new mechanism, but when Greece joined the euro in 2001, the Danish krone was left at that time as the only participant member. A currency in ERM2 is allowed to float within a range of a plus or minus 15% with respect to a central rate against the euro. In the case of the krone, Denmark's National Bank keeps the exchange rate within the narrower range of a plus or minus 2.25% against the central rate of 1 European euro equals 7.46038 Danish kroner. EU countries that have not adopted the euro are expected to participate for at least 2 years in the ERM2 before joining the Eurozone. New EU members equals, on May 1, 2004. The 10 national central banks of the new member countries became party to the ERM2 Central Bank Agreement. The national currencies themselves were to become part of the ERM2 at dates to be agreed. The Estonian krone, Lithuanian litas, and Slovenian tola were included in the ERM2 on June 28, 2004. The Cypriot pound, the Latvian lats and the Maltese lira on May 2, 2005. The Slovak koruna on November 28, 2005. These states have all since joined the Eurozone, and hence left ERM2, Slovenia, Cyprus, Malta, Slovakia, Estonia, Latvia, and Lithuania. Current status equals, as of 2015, only the Danish krone participates in ERM2. The currencies of Sweden, the 3 largest countries which joined the European Union on May 1, 2004, the 2 countries which joined on January 1, 2007 as well Croatia, which joined the EU on July 1, 2013, are required to join in accordance with the terms of the applicable treaties of accession. Sweden has chosen to stay out of the mechanism. This choice is currently tolerated by the ECB, even though it warned in 2002 that such an option will not be permitted for newer union members. Exchange rate bands: in theory, most of the currencies are allowed to fluctuate as much as 15% from their assigned value. In practice, however, the currency of Denmark deviates very little from it. Historical reference equals, the former members of ERM2 are the Greek drachma, Slovenian tola, Cypriot pound, Estonian krone, Maltese lira, Slovak koruna, Lithuanian litas and Latvian lats. See also, List of acronyms, European sovereign debt crisis. Notes and references. External links, European Central Bank press releases. Articles Guardian Unlimited Special Reports Pound drops out of ERM a Euro September 17, 1992.